Welcome back. Thank you so much for joining me in today's video because I have an update for you guys regarding housing affordability. As you guys all know, if you follow the channel, I talk about this quite a bit, but the National Association of Realtors just released July's data, and I want to provide some context regarding how this compares to years past, which I had not done in previous videos here in this detail here. So of course, I have a lot to share. Let's go ahead and dive right in. This is a upload I pulled from the National Association of Realtors website here. So I first want to share pre-COVID levels and then July 2020, how it compares to July this year. Some very, very big changes here. So going back to January of 2020, the median sold price in the US for a single family house was about $269,000. The average mortgage rate back then was around 3.68%. Your average housing payment of principal and interest was about $986 per month. The median family income, this is dual incomes, family income of $82,413. The qualifying income was only $47,328. The reason why I'm telling you this because the trends I'm sharing for this July is like night and day difference here. I want to first provide their definition regarding what is a qualifying income. So according to NAR, this is the income needed so that mortgage payments on a 30-year fix with a 20% down payment account for 25% of the family's income. So back then, of course, because the qualifying income was only around $47,000, and meanwhile the median family income was around $82,000, this means that back in January 2020, the vast majority of Americans could buy a median price home, right? Then let's have a look at July 2020 so we compare that to this year. So the median sold price July 2020 was just under $310,000, average rate at around 3.1%. Family incomes a little bit higher compared to January, and the qualifying income was also slightly higher as well. Now look at how this changes compared to this July. Let me just kind of hide all of this and only look at June and July this year. This is the big difference though, because the median sold price for a single family house this July was just over $412,000. Look at this though, the average rate 6.92% compared to 3.08% in July 2020. Also, the P&I payment, principal and interest, $2,177, and 3 years ago it was $1,055. Now here's the very big change here as well. The median family income only increased from about $86,000 to about $91,000, just under $92,000. Therefore, the qualifying income as well, because rates went up, and of course home prices went up as well, went from about $51,000 to about $105,000. What does this all mean? This means that the average American family earning a median income of $92,000 cannot qualify to buy a median price home today because the qualifying income is around $105,000 versus about $92,000 for average incomes. Therefore, this means home prices have increased by about 33% over the past 3 years. And on top of that, average mortgage rates have increased by about 4 percentage points, going from about 3% now to about 7%. In addition, your average monthly housing payment of principal and interest increased by 106%, going from about $1,000 per month now to about $2,200 per month. Keep in mind as well, this excludes any additional costs regarding insurance and of course property taxes as well. And of course, a lot of you have commented on my channel regarding how much your home insurance went up over the past 1 year, let alone the past 3 years, right? So anyways, looking at P&I though, a giant increase of 106%, more than doubling over the past 3 years. On top of that, we only saw a small increase of 7% for average incomes versus a 106% increase in your qualifying income, the amount of income you need in order to qualify for a house. A very big increase there versus a very small increase of incomes. But wait, there's more, because I found out that the principal and interest payment of $2,177 this July is a new all-time record high. On top of that, this is the second consecutive month that we reached all-time record highs as well, because back in June at $2,166, that also was the record high at that time. In addition, the qualifying income of just under $105,000 is also an all-time record high. It also marks only the second time that the qualifying income has been above $100,000 as far back as our data goes, which goes back to 1989. Also, when you look at July 2020, we were only at 50,000. Now it's at 104,000. So the qualifying income has doubled over the past 3 years. One last thing I do want to mention regarding this spreadsheet here is that their affordability index, which is a measure of how affordable houses are in the US right now, is at 87.8. The lower the number, the less affordable housing is in the United States. So it tied at 87.8 compared to June. And back in June, that was the all-time record low. In other words, all-time record lows for housing affordability that goes all the way back to January of 1989. By the way, once you release August numbers in about a month time from now, I would imagine we're going to get to a new all-time record low for housing affordability because rates have been on the rise. And on top of that, we haven't seen this giant decrease in home prices just yet. I say that about rates because for July, the average rate according to NAR was 6.92%. But for August, according to Freddie Mac, the average rate for the entire month of August for people with great credit for a 30-year fix was 7.07%. Also, you may notice here that the rates stated on this chart right here are a little bit higher than what Freddie Mac has posted on their website here. So because of that, or the reason for this, is that NAR is accounting for points paid by borrowers. Therefore, these rates here tend to be a little bit higher than what Freddie Mac has on their website. So for example, for July at 6.92%, this is a little bit higher compared to Freddie Mac at 6.84%. But because rates increase in August, whether or not you account for the fact that buyers are paying points or not, I would imagine we're going to get to a new all-time record low regarding housing affordability in August. The National Association of Realtors also provides some stats regarding how each of these regions fared. So they looked at the Northeast, the Midwest, the South, and the West. Some really big changes here. So the Midwest, the median price home for a single-family house was just under $308,000 this July. That would give you a payment of $1,625 per month. Look at the West though. The median sold price just under $630,000. Your housing payment would be $3,322 compared to only $1,600 in the Midwest. Therefore, your qualifying income to buy a house in the Midwest is $78,000, where you need $159,456 in income per year to buy an average price home in the West. Can you say not affordable because the median family income is only $100,000? This means the vast majority of Americans who want to buy a house in the West cannot afford it because the qualifying income is $159,000. You definitely pay to live in the West here. I also want to share this with you guys as well. This is a reaction to the Freddie Max report regarding rates this Thursday. So they reported, Freddie Mac reported, that the average interest rate for a 30-year fixed actually decreased from 7.18% to 7.12%. However, this is the fourth week above 7%, as I've been sharing on my channel with you guys. For home buyers, this means a mortgage payment of a typical single-family existing house of $2,221. I mention that because, remember, right here, they're saying here that the average housing payment is actually just under $2,200 per month. But because rates have been on the rise, I would imagine that once they post August data, again, we'll probably get to new all-time record lows regarding housing affordability. They also looked at your average payment for a condo in the US at $1,926 per month. While this is a 2-week decline in rates, the mortgage payment for a $400,000 home purchased today versus last year is $259 more per month. This is because even though home prices are relatively flat compared to 1 year ago, rates have increased from about 5.9% to 7.12%. They also cite here that approximately 35% of houses are selling for over the seller's asking price. Of course, this means that approximately 65% sold at or below the seller's asking price. However, a typical seller is receiving 3 offers on average, according to NAR. Demand is still active in the housing market despite higher rates. They also go on to say the following: the impact on home buyers is clear, but the impact on homeowners and potential sellers is also evident. Sellers are more reluctant to move even if their home no longer works for them or if they get a job change. For homeowners, this means a reticence or a reluctance to take out a home equity loan. Home equity loans could be especially helpful for those in cramped spaces needing to remodel and to help an adult child with college costs this fall. I would say in general, yes, a home equity loan could be a useful tool for that, but not in today's market. I mean, the cost of doing a remodel is absolutely insane. I did a remodel at my house, my wife and I did about, a year and a half ago, a little bit less than a year and a half ago. And the cost of doing that was just absolutely insane. We actually took out, in order to partially fund it, we took out a HELOC. And back then, just to give you some context regarding current rates today, back then we had a HELOC where we had a 6-month period that was 0% interest, basically free money for 6 months. Look at the rates today though. Bank of America, their teaser rate is 7.49% for 6 months. Then it goes up to a whopping 9.72%. Also, according to US Bank, your rate for home equity line of credit or HELOC is 8.8%, but the range goes up to 12.55%. So who in their right mind would take out a HELOC at 8 to 12% when remodeling costs are so expensive right now as well? I can understand why people are reluctant to sell their houses and give up a 7% or not 7%, give up a 3% rate and take on a 7% rate. But I would imagine there's going to be fewer and fewer people who are interested in doing a home remodel when rates right now are around 8 to about 12%. But please leave a comment below with your thoughts regarding this. Anyways, I thought that was kind of funny because I don't think there's a lot of people who are doing HELOCs right now and doing remodels. But I could be wrong. What do I know? Anyways, I also want to give you guys a mortgage rate update as well, because according to the Mortgage News Daily, as of Friday, the average 30-year fix for people with exceptional credit is at 7.22%. FHA and VA is around 6.75%. 1 year ago, you were looking at rates at 6%. That's an increase of 1.21 percentage points over the past 12 months. Also, as you guys all know, I like to share multiple sources with you guys. So according to Investopedia.com, as of September 8th, which was Friday, your average rate is at 7.84%, FHA is at 7.79%, and a 15-year is at 7.13%. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, appreciate you. Also, consider subscribing as well. Hope you guys have an awesome day. Look forward to seeing you on the next video.